From the morning reading, January closes as the SPX bounces on bull flag lows. Apple jumps 3% on earnings per share beat. Biotech lifts. Small cap IWM leads. Breadth strengthened compared to the prior session as advancers led 1889 to 1096 on the New York Stock Exchange and led 1724 to 1090 on the NASDAQ. In other news, the S&P 500 snapshot, a fractional loss for the day, but a 1.79% gain for the month. Markets around the globe continued in selling mode today as Japan's Nikkei falls 1.79% and Germany's DAX drops 1.25%, although the broader European measure, the Stoxx 600 index, closed with a smaller decline of 0.67%. At the open, the S&P 500 looked to resume yesterday's sell-off, opening lower and falling to its negative 0.60% intraday low in the late morning. It then traded in a narrow range until 2 p.m., at which point it rallied steadily to a trimmed loss of 0.09%, a tick off the negative 0.08% intraday high. However, the 500 closed the month with a 1.79% gain. In other news, fund managers are holding the least cash in history. As of the end of December, mutual fund managers had 3% of their assets invested in the most liquid instruments that are readily exchanged for cash. That's the smallest cash cushion they've ever had. And with the increase in short-term interest rates, their cash deficit is now the most extreme since 2007. Consumers are confident also. According to the Conference Board, U.S. consumers are the most optimistic on stocks and pessimistic on bonds in more than a decade. Their confidence on rising stocks and interest rates is almost unmatched in 30 years. Previous extremes tended to lead to lower rates going forward. Utilities look good. In the January 26 report, we took a look at times when utilities got stuck between their 50 and 200-day averages. Whichever way it broke tended to persist, and Tuesday the Dow Utilities closed above the 200-day average, which led to positive returns over the next 3, 6, and 12 months, 7 out of 9 times. Energy stocks are oversold in an uptrend. Fewer than 15% of the energy sector stocks are above their 50-day average, while 75% are above their 200-day average. Of the 41 similar days since 2000, XLE showed a positive return 2 months later 37 times, an average return of 8%, with an average risk of negative 5.4% versus the average reward of plus 13%. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:59 a.m. Mountain Time, and I'm recording this in preparation for the market day, February the 1st, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were positive. S&P futures are up about 0.25%. Russell futures up about 0.33%. NASDAQ futures on those Apple earnings are up about 0.5%. Dow's up about 0.25%. Crude oil's up about 0.75%. The euro is at scratch. Long bonds are down about 0.33%, and gold is up just above scratch. In overseas action, looks like China's still closed. Hong Kong is open though and down just below scratch. Japan up about 0.5%. Germany up about 1%. United Kingdom up about 0.5%. In macroeconomic reports for the United States for today of note, we have the non-farm employment change, ISM manufacturing, crude oil inventories weekly report, and the FOMC statement and Fed funds rate. So look for quite a bit of action both before and after the market opens today with the Apple release as well as the Fed and other reports. Pretty busy day actually. In terms of current volatility conditions, short-term VIX 11.77, skew elevated at a 138. IV percentiles still very, very low, with the S&P coming in at a 13, the Russell at a 16, the NASDAQ 11, and the Dow at a 22. No standard deviation size moves were put in on any of the 4 U.S. broad-based indices on a close-to-close basis yesterday. Okay, let's go ahead and take a look at current charts. And here is our S&P futures, and you see the current short-term action where we broke up towards the top of this channel and had the multi-day island reversal pattern, and that seems to have found support a couple days in a row. We have tested this area, and there's a key moving average line in the area, and both days were well repulsed from those lows of the day to close quite a bit up from there. Now, so far, this seems to be building on that, perhaps on the backs of the Apple release. That's a very big deal. Apple is a big part of all these, it seems like all these indices. Certainly it has a major impact on many people's holdings. One thing I did notice about Apple, and you can get your own reports as to the, all the ins and outs of that, but they're sitting on some $250 billion worth of cash now. So just monstrous, and really drives home that message about repatriation of that money. Hopefully we'll see something come out of this administration and Congress which will address some of this. That could be capital that could be put to work, and that would certainly help with the economic growth rate. And then other markets, you have the Dow. And with the Dow futures, we have much the same action, the same island reversal, a little different coming off the bottoms in that it's not similar as it was with the S&P futures, but certainly both days repelled off the bottom. We'll take a look at the NASDAQ, and of course the NASDAQ heavily influenced by the Apple release, and you can see so far positive for today. With the NASDAQ a little bit of kind of halfway in between both the intraday action of the S&P and the Dow, and you have kind of a similar low, and again the big wicks on the bottom with those big repulses the last 2 days. So it would seem that there is support, short-term support in this area, and that the bears, while they've made something of an effort in recent days, just don't have an awful lot of energy and momentum, and frankly, there's just not that much fear in the market. We're going to talk more about that in just a second. Let's take a look at the Russell. Russell continues in the sideways consolidation pattern. Recent action touching this lower support area, but closing just above the cloud. So we'll see if we can build on this. The primary thing here, though, is that it's in a range. So cloud, support, resistance, all these kinds of things are really defined by this overall pattern of support and resistance that goes back now over 2 months. And then let's see, let's take a look at some of the other markets. Crude oil also sideways consolidation pattern, nothing really to get excited about and talk about there. Gold, of course, had the big move yesterday, and some conversation that was coming out about currencies and so forth. You also saw a big move in dollar. We'll look at that chart in just a moment, but big move in gold, but still within the overall context of being within the cloud, neutral posture, up against these similar highs, has not yet broken these similar highs, so we'll wait to see where that goes. Short-term pattern continues to look bullish in that you had this big counter trend move. You had a higher low, similar highs, a lower low, and now coming back towards similar highs. So whatever this does to resolve, and really I'd want to see this either break out above the cloud and make a run towards these highs, or I'd want to see it break below not just the cloud but below these swing lows before I had much of a strong feel as to what gold really is about in terms of its current trending action. I could see a case where this could go either way. It's probably going to be related to what the dollar does. And much like gold, you see the dollar had a big move yesterday and actually was a cloud breakout to the downside. So after being so strong for so long, the dollar seems to be in a mighty counter trend move. And you have to question if we maybe have broken the trend, at least for the meantime. We clearly have broken both diagonal and horizontal support areas. So if this were the S&P, we would be talking about, a market phase 5, break of diagonal and horizontal support, and a bearish kind of market phase. So the dollar, at least in the short term, seems to be building on its bearish moves. And then let's take a look at bonds. Bonds, kind of in a complex sideways consolidation pattern after the big intermediate term bearish trend, a bit of a counter trend move, and then what would seem to be a higher low, but then a lower high, and then a lower low. So this would seem to all be a complex sideways consolidation pattern. We looked on the weekly chart yesterday, and it just looked like a bear flag, and the expectation would be that bonds would break down. And then finally, take a look at VIX. And while we've had some efforts by the bears to increase volatility in recent days, it's been rejected both times. And currently, we're below a 12. And, normal bull markets operate, oftentimes in the 12 to 15 zone, and we're still below that. So this is a context that you've got to keep in mind. While it seems like there's been a little bit of bearishness kind of tint to the market and some recent action, there is absolutely almost no fear here. And within the context of, this level of volatility, this weakness that we're currently experiencing really needs to be seen within the context of just noise. And anything more than that, is probably an exaggeration for, somebody's particular purpose. Now, that being said, we're going to certainly watch to see if this builds, and that's part of the purpose of what we do in the daily report. We look for change, and we look for the rate of change, and we've had some change, and we certainly are watching to see if this can build on this early energy and start to go somewhere. This is like the snowball at the top of the mountain. It's just started to roll. And, does it run out of energy and comes up against a little bit of a uptick of a slope and it just kind of dies? Or does this thing start to build and start to really roll down the mountain and something much more significant? Well, right now, one of the first things we saw that changed was this break of diagonal support. Not really a break of horizontal support yet. So this is kind of a weak market phase 5. It also has oscillated between phase 5 and the bullish phase 4s or phase 3s in recent sessions. So again, very, very weak signal coming from there. In terms of the three market timing signals, really no change here in several sessions. So the first signal coming from IBD, confirmed uptrend, that's bullish. The second signal, GMI index, actually improved yesterday to a 6 out of 6 with a buy signal in place since 11:10. And the third one, stock charts decision point scoreboard, still the same mixed signals that we've had for quite a few sessions now, mixed signals on the short and the long term. And basically that's one of the ways that we read the tea leaves to say that expectations to the downside are mild and expectations to the upside are mild. So until you start to see more of a stack coming into these various time frames and so forth, we're not likely to get very far in either direction. So it certainly doesn't call for a lot of fear. Current position sizing opinions on both models are still pointing to 100%. In the intermediate term market posture, there's a couple changes here. The S&P at an 84, still holding on to the exceptionally strong bull, but that I thought I had changed this. This line right here, this indicator, this sentiment line, which is a longer term line, has gone flat. So this is actually a neutral sentiment line right now. So you're not getting that kind of support to the exceptionally strong bull intermediate term market posture anymore. It's turned more neutral. Also showing some signs of weakness is the Dow. Dow has cracked below the 80 and gone into a weak bear intermediate term market posture. NASDAQ still exceptionally strong bull. Russell in a strong bull stance. So you can see we've got, some mild warnings here, but nothing too explosive by any means yet. Overall hedge warning status 0 plus, normal with some elevated conditions. No change in the strategy opinions. VIX is still below the acceptable range. It's below a 12, so initiation of new positions by novice traders for option income strategies could have some problems related to low premiums being paid for the amount of risk that you're taking on. So just kind of keep that in mind. Now, there are places that you can go to look for more volatility and more premium. So that might be one of those options. Another option would be to reduce your position size. A couple things just to keep in mind. It's not optimal conditions right now for option income strategies. And if we were to start to heat up, you could find yourself run over and very little initial premium to be worked with and making those adjustments. Cover calls, put selling, conditions are acceptable is the opinion on both of those. Relatively conservative stance still in the construction of covered calls, given that we have been in these kind of oscillating between this break of diagonal support versus these expansion and up against resistance kind of patterns, and an expectation we're not likely to go explosively to the upside or to the downside, being the highest probability kind of opinion. Now, when you come down here and you start looking at the areas of specific warning, you can see we actually resolved some of these from yesterday. And, these first two went back into their normal status. They're no longer in warning status. The volatility ratio fired 2 sessions ago. And, so it doesn't seem to be building on that as of yet. VIX is actually below a 12, so we're really looking for an expansion of volatility and have yet to be realized. Distribution day count, just a bit into the warning area. NASDAQ at a 6, the S&P at a 5. Skew is elevated. This is a relatively serious level at above a 135. That's about a 12% probability of a 2 standard deviation move in the next 30 days. In terms of the trend base, we have that one mild warning with the market phase 5. The other two are fine. In terms of the intermarket risk aversion indicators, you have one is risk off, one is risk on, barely. And then 3 I put as outright neutral, and that they were just about as flat as they could be. So this overall picture here is about as neutral as you can get. Also basically neutral is sentiment. Sentiment on stock short and intermediate term, and with the fear and greed index, are all pegged in the neutral area. So this market is about as finely balanced, sitting on this fence between the battle of the bulls and bears as it can get. In terms of sector specific, you could see that the overall performance yesterday, while essentially scratch, was mostly dominated by the defensive sectors. Utilities doing well, and you heard one of the morning authors mention, the movement above key moving average lines and the likelihood that utilities would build on that performance with a breakout from that area. Also, real estate, consumer staples, telecom, all these areas are defensive in orientation, whereas the risk on, all down here at the bottom, financials, industrials, materials, tech, consumer discretionary, and energy, all negative and with negative breadth across those sectors. So transportation, energy, financials, industrials, technology, retail, all showing some signs of weakness. The most pronounced being retail, though there's been some improvement in retail as of late. So just be careful with retail in terms of getting bullish on that. If there are going to be ramifications down the road on these import-export relationships, these trade partnerships and so forth, this would negatively impact likely companies like Walmart and other big-time importers, increasing their cost of goods sold. So that being said, any kind of move up in retail might be actually a selling opportunity. It's hard to believe that we're done with that story only into the second week of the new administration. This is likely going to be a continuing theme, much like healthcare is likely to be a continuing theme. Healthcare has actually had something of a rebound in the very short term, and biotech part of that, but it's hard to believe that healthcare is going to do anything significant and with persistence given the current environment. And you see the 1 month performances. We'll start to see more and more about this consumer discretionary, information technology, materials. In general, the risk on, while they didn't do well yesterday, and you see most of these are negative yesterday, they have been the strongest performers in the last month, and in many cases the last 3 months. So the risk on area of the market looks to still be the primary performance drivers over the intermediate term. Okay, that's enough for today. We're busted up a little over 20 minutes, so let's get this thing to production. Been a bit long lately, but there's been just so much stuff going on with the new administration and so forth. And in terms of disclaimers, always got to have the disclaimers. Hit the pause button if you need to have more time to read this. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. We'll be back here next time with our market preview from Falcon Global for tomorrow's session. In the meantime, manage that risk profile. You'll see everything else fall into place. Seek to go out there and learn something about your trade craft every single session. Good trading.